Well, hello everyone. Welcome to another in our series of tax planning masterclasses with some of our sponsors from our webinar series that we're running every day from 10 o'clock this week. This week being the 4th of January forward, if you're watching on catch up, as it were. I'm very pleased today to be with Jessica Franks from Octopus Ventures. Jessica, do you want to say hello and introduce yourself?
Yeah, thanks, Mark. Hi. I'm Jessica from Octopus Investments, and I look after all of our tax efficient investments, including our new Octopus Ventures Enterprise Investment Scheme service.
Thank you very much, Jessica. So look, we've done many different themes and topics within these videos, and we cover a lot of different areas. We thought for this one, we go back to basics, back to 101 EIS, and let Jessica tell you effectively what an EIS, what an SEIS is, what all these silly acronyms mean, and give you the kind of the lowdown from a very basic level as to what's going on in this world. So Jessica, can I press that? Just start it there then. Just tell us EIS. Why do we have EIS? Started 25 years ago. Why is it still going today? What's it all about?
Yeah, it's a good one to ease me back in from Christmas, I think. So thanks for that. So as you say, EIS, Enterprise Investment Scheme, has been really successful. It's been around for 25 years now. And put very simply, it's a way that the government encourage investors who are happy to take more risk with their money to invest into smaller companies with growth potential, with the hope and expectation that those companies can use the capital that investors put into them to scale, grow, create jobs, be really at the sort of forefront and centre of the UK's productivity, creating the next generation of companies that employ people. So pretty topical right now as well, but has been important to the UK for the last 25 years. And actually, Enterprise Investment Scheme is seen as having played a really important role in making the UK one of the best countries to start a company and be an entrepreneur and try and grow a business. So I suppose we all owe a debt of thanks to all those investors that have participated and taken the government up on the tax reliefs that are available to them for taking that extra, it should be said, high risk with their money by backing startup companies.
Yeah, and one quick question on that point. So we've seen during COVID and the pandemic, etc., obviously the government's put a lot of debt funding into businesses. So why didn't they do that a long time ago? Why are they asking private investors to put their money into small companies rather than, why aren't the banks doing it? Why aren't debt funders doing it? Why equity, I guess is the question.
Yeah, I guess companies have access, or some companies have access to lots of different forms of finance, but quite often smaller companies don't have access to lots of debt, when they're starting out. And servicing debt can be difficult for smaller companies, can be expensive, and take up money that they need to actually invest into the business to grow. So sort of starting to come onto what an EIS qualifying investment might look like if you're an investor, they tend to be pretty long term. And the sort of time frame that we think about, so Octopus is 5 to 10 years. So if I say 7 to 8 years as an average in the middle, and you're not expecting the company really to be paying you out dividends during that period, you're expecting your capital to be put to work in that company to help it grow, to be paying its staff salaries and all those costs that it needs to pay in order to actually function. And as it goes on, it probably would need to take on more capital financing, equity financing to keep growing further. So your seed enterprise investment scheme and then enterprise investment scheme money is probably some of the first money that's coming in, not necessarily right at the start, but pretty early on. So those companies may well go on to take on some debt financing either alongside or later on, but it's really there providing a solid capital base to give that company some real solid stability and support from the start.
And I guess the attractiveness from an investor's point of view is obviously because debt funding isn't going, you get a stake in that business, you get a share in that business. Obviously, hopefully it goes from being a zero to a hero, it goes through, and goes on to be a Facebook or a Google or an Uber or whatever, and you make lots of money in the meantime to be able to do that. But I guess on the flip side of that, there's a lot of failure stories out there. We all know the kind of rates for startup failures is pretty high, and that's why we get the tax reliefs. So do you want to quickly kind of talk us through the tax reliefs, what they are and how they work?
Yeah, and absolutely spot on. There's no free ride with these things, are there? No. And nor should there be. So you're right. The Enterprise Investment Scheme recognises that no matter sort of how good of an asset manager you are, how well you do due diligence at the start to think that this company's got really strong potential. When you're investing in smaller companies and you think they've got an exciting growth journey ahead of them, all manner of things can crop up along the way that might mean that they're not going to become the success story that you hope when you invest or you expect. And that's part and parcel of EIS investing. And I think the government recognised that when they structured the relief. And actually, enterprise investment scheme relief is so well suited to investing in these early stage smaller companies. Investors benefit from a 30% income tax credit upfront on their investment. So for every £1 you invest, you get 30p back. And that, I think of that as giving you a sort of base level of an initial, to some extent, risk mitigation, because for the £1 that you've put in, it might feel to a lot of investors like it's only cost you 70p, and that tends to be how people think about it. But from there, you've got your £1 invested into this small company. And the tax reliefs recognise both sides of the coin, actually, both sides of the potential journey. So should that company grow in value and be really successful over the 7 to 8 years that I talked about at the start, and secure you, one of the original groups of investors, an exit, then your capital gain that you've made on that £1 that you invested is free from capital gains tax. So that's really attractive upside for an investor. On the flip side, and quite unusually, because tax tends to be normally equal and opposite, so it's quite unusual and pretty attractive actually for EIS. If that company should fail, and as you said, it does happen, investors are able to claim loss relief for the losses that they've suffered from that net 70p that they feel like they invested net of the initial tax credit. And even more attractively, that loss relief can be set off against capital gains tax or against income tax. So for a high rate income tax payer, that can feel like an extra 45p back on the amount that they've lost on their net investment amount. So it's a really well designed tax relief, I think, completely well suited to investing in these small companies. And the other piece that shouldn't really be overlooked is that most investors tend to invest in a portfolio of EIS companies, either quite often through one manager that will select a portfolio for them. You could do it yourself if you're closer to smaller companies investing and that's what interested you. But no matter how well your overall portfolio performs, you're still able to claim that loss relief on an individual company basis. So that can lead to quite an attractive portfolio position, even if you're in a situation where, let's say, 5 of your companies are very successful and 5 of them fail.
Brilliant, thank you. So yeah, but basically buy tax reliefs in one investment, one of the most tax advantaged schemes in the world, and as you say, very much an envied scheme across the world as well. We get quite a few other countries come and talk to us about the scheme, about how successful it's been, and pretty much want to replicate it in the countries they are in. So we've had France, Canada, United States, China, all kind of talk to us about the scheme just within the last couple of years, and looking to do something similar in their own country. So yeah, it does what it says it will do. It raises money and it helps private investors with tax reliefs along the way. So typical investor wise, obviously I know Octopus have been in this game for a long time with VCTs and EIS and IHT and BR products as well. Typical investor, is there a typical investor for an EIS or an SEIS product in your opinion?
I think as far as you can ever say there probably is one. I think that it's someone who's a pretty experienced investor, who's got probably quite a solid portfolio of more mainstream investments. They fill their ISA every year. They're probably also have a decent pension pot built up, and they're looking to invest in something that probably feels, and probably rightly feels, like it's higher risk, longer term investment, where they're actually getting closer to some of the investments that they're making. I tend to find that EIS qualifying investments you feel a bit closer to the companies that you're backing, because it's not a fund. It can't be a fund. You have direct ownership of the shares in however many companies in the portfolio that you end up investing in. That could be one company, it could be several. And you know that you're going to be holding those shares for really quite a long period of time, because they're not liquid investments. There's no exit for your SEIS or EIS investors until that company reaches a major milestone in the future and there's an exit for sort of a whole tranche of shareholders. So it shouldn't really appeal to people who are just sort of dabbling with a few £1,000s here and there on a short-term basis, thinking they might need this money back sometime soon. But it really should appeal to those investors that are interested and keen to invest in tomorrow's sort of superstars, as you said earlier, that opportunity to back companies that may well become the household names of the future, and to know, once I have the bragging rights of saying I was in there from the start, to follow that company's journey, you know, to find it really interesting, to have seen how their money's worked over the 7 or 8 years that it might take to get there. But as we've been saying, also the kind of investors that understand the risks that come with that kind of investing and are happy to accept them and understand that not every company that they're going to invest in is going to be successful. There's going to be some failures along the way. But that's something at this point in their investment journey, they're really happy to take on board, with the opportunity to generate multiple returns from those companies that are successful.
Yeah, I quite like the analogy that it's almost your mate down the pub investment. You can go and tell your mate down the pub, oh, I just invested in that new, that new tech company or that new COVID. There's quite a few companies out there obviously that are doing stuff with COVID and around that. Kind of telling your mates that I've invested in the next thing that's going to help get rid of COVID. You know, that's a real good factor in terms of not just making money, but also the good that you're doing in a wider society sort of sense as well. So I think that's probably a good way of seeing it as well.
Yeah,
the type of companies that you invest into, obviously you talked about funds and kind of 6 or 8 in a portfolio, et cetera. Presumably, as with most clients' portfolios, when IFAs are talking to clients, you try and diversify across companies as well and have quite a mix. Could you just tell us your approach to kind of company selection and diversification?
Yeah, so our enterprise investment scheme service invests in between 10 and 15 companies for every investor. We designed that based on feedback from advisors who said that was the sweet spot for them. Obviously, you'll always have some differences of opinions out there, but on average, that was seen by advisors as the number that suited them the best. I think it was seen as sort of any more than that, it got a bit fiddly, or almost like too many companies to try to keep track on, potentially too many EIS certificates to have to deal with, and also maybe a bit too much diversification, you know, people wanting to go for that real potential to maximize growth and not wanting it spread across more companies than that. And on the other side, obviously, fewer than 10 was seen as too concentrated in a world where we do expect failures, like every EIS manager, I'm sure. We do expect failures on the way in. Obviously, that's not what we're looking for when we're assessing the companies, but experience teaches us that they will happen. So we don't want anybody's portfolio concentrated too much into too few companies. There are services out there that invest into fewer companies, and I think some advisors create extra diversification by selecting more than one EIS service for their customer and adding diversification in that way. So there's plenty of ways to go about it, but I hope we've tried to provide enough diversification in one service so that if people do want a one-stop shop, they've got it.
Yeah, very good. And a kind of final question, if I may, cheeky one, but we're heading towards obviously tax year and we're heading towards a budget as well. There are lots of stuff in the paper around wealth tax or pension release being cut. Is there anything you would like to see, or you're hoping to see, or are you hoping kind of a period of calm and stability? What's your crystal ball telling you?
What would I like to see? I mean, I think stability is always good, especially now. There's been so much change that we've all lived through in the last year. I think it's really important for investors to have certainty, because I think investors in this space can be really genuinely be part of the solution coming out of this pandemic. I think we see firsthand the benefits and the difference that investor capital can make to these companies growing. And I think anything that disrupts that, even outside of EIS world and just general investment world, doesn't feel to me like the right way to go right now. I think if I was a betting person, I don't like to make predictions about the budget. They're rarely right. But pensions has been such a hot topic. It feels like a bit of a sitting duck, the high rate tax relief on pensions, I wouldn't be surprised to see a 20% flat rate that I think's been sort of mooted for years now, coming in on the back of this economic situation that we're in as a way to usher it in.
Okay, so we won't hold you to that one. We'll wait and see what happens in March. It's March the 6th, isn't it, from memory, I think. So
give me a call after the budget, Mark.
Yeah, we'll see how we go. Hopefully it might be our lockdown by then as well. Who knows? Well, thank you very much, Jessica. That's fantastic. As I say, a bit of a run through of kind of all things EIS, a bit of a back to basics in EIS. So it's a really good starting lesson. And if you want to pick up any of the other videos we've done in this series, we've got 5 or 6 now. They're really good tax year end planning ideas if you're thinking of this market at the moment. So please do check them out on our website. Jessica, thank you very much. Great to see you as always. Take care. See you very soon.
Bye.